Hello and welcome to the latest episode of the Later Life. No, not that. That's my first swear. Hello and welcome to the latest episode of the Advice Guru Later Life Lending Podcast. Well, Stuart and I are delighted to be joined today by a man that many of you will know, but perhaps many of you not know that much about. So we've decided to invite prestigious guest Robert Sinclair onto the call. So hello, Robert. Hello, Stuart.
Hi,
Hello.
good to be here.
Fabulous. Well, we've had a bit of a pre-chat and found out some fascinating facts and perhaps some things we can delve further into. But yeah, we'd love to have a chat about your career, looking back, and the future. How does that sound?
That's great. No problem.
Fantastic. I mean, it is great to have you on. I'm great admirer of yours. Sat through many presentations of yours over the years. Including just recently the Equity Release Council Summit in Sheffield, which I thought was a great event. At the end of that event, you shared some thoughts and some takeaways from that event, and it'd be great to kind of touch on those a little bit later on, actually, and talk a little bit about those as well as your career and what happens next. So you just recently announced your retirement from the role. But before we get into that, as Stuart said, not everyone listening to this will necessarily know that much about you. So it'd be good just to get a little bit more of the potted history of Robert Sinclair and your role at Amy. So can you just tell us a little bit about yourself?
So I started my career in the world of banking and worked for Midland Bank and HSBC, then Abbey and Santander, before coming into the world of trade bodies in 2006. So I initially joined what was the Association of Independent Financial Advisors as to look after the second charge market. But then as the financial crisis arrived in 2007-8, I took over the mantle of actually being director of all three trade bodies. So AIFA, Association of Mortgage Intermediaries and the Association of Finance Brokers under I call it the tutelage of a guy called Chris Cummings, who now runs the Investment Association. And really, for all of this last 16-year period, been fundamentally involved in trying to make sure that Amy is at the forefront of thinking in talking to regulators in particular, but also parts of government. That's Treasury and Ministry of Housing, Communities and Local Government and the Department of Energy and Net Zero. So because they're very important component parts of what advice in the housing and mortgage market is. And I would argue that in that period of time, what we've tried to do is make sure that advice is at the heart, is at the centre of everything that goes on. The customer's at the centre of everything that goes on. We get that bit right, and then the rest will just follow. And also, I think, fairly passionate about the fact that the choice, having product choice, is actually always the best thing for the customer. So single-tied sales routes I've never liked, which is why working in big banks, I always found the job quite difficult. And coming out into this area where the passion is to actually give consumers the widest choice possible through advice is the right answer. And that's really been the thing that's driven me over the last 12 years, in particular when Amy's been independent.
Fantastic. And during that time in that role, I mean, there's been tremendous change in our industry, tremendous change in regulation, and we can come and talk. I'm sure the words consumer duty will come up at some point during this podcast. But what are as you look back over that career and look back over the various roles you've held and the trade bodies that you've represented, what are the kind of biggest challenges you think that the industry has overcome, and what are the ones that we are still grappling with, you think?
I think just getting originally the head around regulation itself was a challenge in 2004. I mean, just as mortgages became regulated and then insurance behind it in 2005. The industry started as almost Amy being the producer of all things compliance. We had fact sheets galore telling people how to comply with regulation. If I look at the organizations that I see now, Amy's much more about being a lobbying body to ensure the regulation that comes is effective and doesn't constrain firms' ability to trade profitably. Because actually, most organizations have now got well-developed, not just compliance function, but risk and compliance functions. Even in the intermediary space, I see that. And you see that professionalization because the regulation has forced them to go there to a degree, but also if you look at the way that their professional indemnity insurance is covered, and also if anybody wants to actually sell their business at the end, they know they can't have too big legacy issues at the back of it. They know they've got to be compliant and working within the framework, because that's the only way that somebody who's looking to acquire them will give them value. And so I think we've seen that vast shift in maturity over the period that's changed the infrastructure enormously. We've also seen technology arrive in a way which, when I started, the technology was fairly rudimentary in terms of price comparison websites, and very simple. We've still got a distance to go on some of that, by the way we adapt and use technology in a way and get advisors to really understand that what's available within technology and how it's used. Because I think we've got more capacity in the technology than is actually embraced and used. But I think that shift on technology has been significant as well, but not to the degree that I think any of us would like. I think the last bit is that the other change is that when I first arrived, the world of the lender and the world of brokers was almost a conflict. And as I walk away from the industry, it's much more symbiotic, and people understanding that they have to work together in order to get the right things coming out of the back end for the customer. And it's that partnership and collaboration, I think, has shifted enormously over that last decade in particular.
Yeah, you mentioned technology there. I want to come back to that actually, because I know you've had, in fact, just in recent months, you've said some really interesting things about technology and AI in particular. But just going back to this progression within the industry, you mentioned regulation. That's a consistent and constant theme, of course, as in financial services. Lenders, advisors, stakeholders in this industry have all grappled with that thorny issue. What about the regulator itself? Have you seen changes there? What's your view on that?
I genuinely think they struggle with. If I look at it, they look at industry as a whole. I mean, they probably view the financial services industry through quite jaundiced lenses, in that on some edges you've got things like, CMCs that they've had to really, really drive in to moderate and change behaviour there. They've had the whole issue with funeral homes that's come in and very difficult for them to get their heads around. The whole consumer credit regime is very difficult. And how do you actually regulate, from a consumer credit perspective, the activity and behaviours of people who are selling point of sale finance for motor vehicles or 3P suites, in the same way that you've got the complexities of pensions advice on later life lending, advice on a mortgage, which are elongated transactions that require a different philosophy, I think, in terms of how those operate. And I think they struggle to get their head around that complexity of all of it. There's another element I don't think they understand at all, which is, I worry much more about the firms who are big on the high street, if I call them that, because they're firms that can probably do a little bit of sleight of hand and not be noticed, as opposed to the one-man band, whose most of his business comes from the football club, golf club, rugby club, school gates, who are never going to actually do that much to damage their friends or their children's friends' parents. That isn't going to happen. So I don't think they even begin to think about those type of very simple differentiators. And also, the best example recently is they've just been asked by government, rightly, to stand back and look at how do they make the UK financial services more competitive, but how can they reduce the burden of regulation? Their answer to that is to go out and ask the industry. I mean, it defies belief that an organisation that's got all of this regulation in charge of it doesn't know itself what it can take away safely to leave people in a good place. I find it weird beyond belief they've not got the self-confidence or knowledge or understanding to make those judgments themselves.
Yeah, that's fascinating. I really agree with that. And I think we're just leading on, so I think it's a natural progression then into the situation.
So I'll just go back a bit on that as well, because there's been a big criticism coming out of Parliament recently. A number of MPs and Lords have said that either they think that FCA is incompetent or worse, could be corrupt. Now, great, and that's probably getting a tidal wave coming at the FCA that says abolish them, get rid of them, That is not the answer either, because if you generally look at this, what do you replace them with? We dismantled the FSA and created the PRA and the FCA, and here we are 10 years later going, it's just not good enough. Well, it's not good enough because either the people that go in there aren't good enough, or they're not led well enough, or actually the industry isn't helping them enough. And I sometimes think, when you look at the amount of claims that are still running through in life and pensions, 300 million a year, every year, still flowing out of the system because people selling life and pensions do it really badly. Whereas in the world of mortgage and protection, for the second year running, there is no fee being levied by the compensation scheme because no firm has failed that has given bad advice in the recent past. That says something about the way the mortgage and protection sectors are operating versus what's happening in other parts of the landscape. That's why I think they're just not in the right space philosophically.
Yeah, very good point.
That's a really good point there that you raised, Robert. And I guess this borders on something that has always concerned me. And I know in our pre-chat you were discussing. So we advise within later life lending. I'm an ex-mortgage advisor. I'm ex-Santander and Abbey. So I've done a lot of your routes. But I've always found that there's almost a snobbery from IFAs and investment advisors about mortgages. And I'm not sure whether they, as their holistic advice, are including what we do. Do you see that?
Yeah, I'm not. When I talk at personal level with my own IFA, he knows the value of my property, but doesn't really. We're not having a discussion about whether we would ever use that as an alternative. There's a fairly logical thing here that says, why not take the money out of the property first? Because then you've got all the assets under management still sitting there earning fee income on it for you, maybe. But most of them don't begin to go down that road of really thinking about what that more balanced discussion is about total assets as opposed to investable assets. Now, and most IFAs I come across, when I begin to talk to them even about would they think about it, are very reticent to go down that route. Now, I understand why that might be the case in that there are very good reasons for segmenting out your product set because your PI insurer has a view about what you're expert at. But if I go and talk to the really big firms, the really big firms like the St. James Place, the Open Work, the Quilter, who've got multi-structures, carry all permissions with them, how they actually legitimately say, well, for this customer, we're only going to talk about this and ignore all this other stuff that they've got permissions to talk about, is quite a brave call, in my view. If somebody comes along later and says, well, why did you not talk to me about that? Well, the answer is, well, we told you we weren't going to. Does it feel comfortable in a modern world where actually we've probably got the ability to do a bit better than that by putting advisors together in the room, which is genuinely what used to happen when I was back in my advising days in HSBC. We would be involved in some very, very complex tax planning for some people, but we had tax specialists that came in and sat alongside us when we did that. If we were looking to, I was one of the few that's allowed to sanction mortgages. I had a lending background before the investment side, but that meant all lending that was being done in the private bank there in the north came through me. Now, it's marrying the right skill sets to get the right people to give the right advice, because consumers don't walk in saying, I only want to talk about this. They come in with, I've got this problem, help me solve it.
Yeah. And you mentioned, I think you mentioned recently that you had some thoughts, concerns, whatever you describe them as, about the issue of foreseeable harm. And I think we're coming into that now, aren't we? And you wondered from a consumer's perspective what they feel about that, what that means, and what that means for the future in terms of complaints and the ombudsman. And I guess you're kind of touching into that now. It's what does the future hold? And
how can you sell a standard resi mortgage without having a decent discussion about protecting the cash machine that's making the repayments? You have to make sure that person either is fully protected or understands what will happen because they've decided not to do that, or what the risks are around not doing that. And similarly, I think there's always that foreseeable harm issue of, in the world of people reaching that decumulation phase, of them not having a meaningful discussion with somebody. Because you can have a meaningful discussion about what the options are without going near what's technically regulated advice. Because regulated advice is when you make that actual decision, do that through this product provider. That's the regulated advice bit. The rest of it is a conversation anybody can have with somebody that says, have you thought of this? Have you thought about that? Have you considered this? Do you want to think about that? Or because that's not regulated advice. That is a discussion with the customer about what their alternatives might be. Everybody gets really wound up in the PI insurers and in the risk committees about, well, are you getting that areas of regulation? I understand why they worry about that. But under the technical part of the rules, well, hard to pin the tail on the donkey for the regulator on that one.
From what you've seen, then, who's good at it? What bodies, networks, advisors?
Well,
who's good at being holistic?
I think we're on a journey. I genuinely think we're on a journey where there are advisors out there who are, investment advisors who are part of SOLA. There are certain groups of advisors who are very, very, as firms, more holistic than others.
Mm-hmm.
What I am seeing at the moment is that more mortgage networks are making sure they've got in their sphere the ability to refer to an equity specialist where it's appropriate. So if I went back 5 years, that didn't exist. Similarly, in the world of protection, if I look at the way the evolution's happened there, we've now got a whole load of protection-only advisors sitting in many of these organizations because they've become more specialist. Similarly, I think we are seeing a move for people saying, well, if a standard resi doesn't fit or if Rio doesn't fit, then there is something over here that I can get somebody to talk to you about. Are you interested in that? Because that's the conversation that should be happening, because if you go back and really look at the heart of consumer duty, the regulator is saying, if you've persuaded somebody to come to talk to you and they drop out the sieve, why did they drop out? Why did they drop out the sales funnel? Because that's what duty is all about. Duty is managing that sales pipeline to say, why did somebody want to start a conversation and then stop the conversation? Was it because you didn't like you, or you didn't offer them the right outcomes that matched their needs? And measuring those people who drop out the sales funnel is as important as measuring the ones who reach the end of the sales funnel to make sure it's appropriate.
Yeah.
And in my view, that's what duty is about. It's more about that. Branding and marketing yourself to the people who you can genuinely meet. If you're marketing, people come into your place that you can't meet their needs, you still need to find somewhere to put them. You can't just go away. That's not the answer to the problem.
No, that interaction between advisors of all sorts is something that Stuart and I hold very dear, and it's something we'll talk about.
But I still think we know there's an element of mistrust between various groups within and arrogance. There was a beautiful phrase used by somebody at a protection conference I was at last week, where this younger, newer person, fresher into the industry, accused many of the older people in the room of having intellectual arrogance and not being prepared to think differently.
And I think that person's probably hit the nail on the head for a lot of things. But Robert, you've mentioned equity release. Surely you hate equity release, don't you? Isn't that the
absolutely? I'm the scourge of the equity release industry. But mea culpa. Something that's not very known is that a number of years ago, my mother, living in a set of a flat in Edinburgh, that block required remedial work on the property, which meant she had to raise money as part of, or needed money to pay her share of the remedial work that needed done to the roof and the fabric of the building. And the choice at that point was, did I pay for it, or did she pay for it by taking out release? We made the decision that she would actually take responsibility and got equity release. So for anybody accuse me of that or say or me be critical of equity release would be a little strange, because I actually encouraged her to go down that route, and she's now in care. So the flat's been sold and the loan's been repaid, and she's now in a care home. But I saw that as the best solution for her at that point in time. Now, I'm critical of it because I do see parts of the industry that I think need to change some of their behaviors to build that trust that I think needs to be built between the different elements, because some of the, let's call it the commission levels and the fee levels, look disproportionate. The best explanation of this, for many firms, the cost of acquisition is so great because of the advertising they have to do. That's where the commercials have to go to make it work. The reciprocal answer to that is, if they could get the lead flow coming out of standard resi without having to pay for it in that way, it would totally change the commercials. Therefore, as an industry, we have to think better about how we engineer that, as opposed to everybody standing on the sidelines griping about each other and saying, this isn't right, it doesn't work. It doesn't, you're right. So what do we have to change to make it work? That's the challenge.
Yeah, I think it's a nice segue actually into. I was very lucky enough to attend the Equity Release Council Summit a couple of weeks ago, where you attended, Robert, and you did a bit of a summary at the end, and there are a few key takeaways that you gave there, which I think sort of play into that what we've just been talking about there. I think you highlighted the need for the industry to get better, or advisors to get better at building referral relationships, because it's so important to make sure that the clients are being referred to the right specialist. You talked about the need for a use of simpler language for consumers to be better educated for the industry to get better at delivering messages in different ways, using different media, not just relying on the same old tried and tested methods all the time. So I think that does play into what you were talking about there in terms of if consumers start their journey better educated, better informed, they're more likely then to seek out services of advisors throughout the life and into later life. So those are kind of things that sort of keep you awake at night in terms of the industry.
I was talking to an advisor the other day who's now got 80 1 to 2 minute TikTok videos, and you can go into their website and click on them, and ask the question, and there's a 90 to 120-second answer to the question on TikTok. Now, I think that's brilliant, because that, for a modern generation who want to listen and learn in that way, is much better than, here's a brochure, would you like to read it? Oh my God, are you joking? Or as happened to me recently, because I went to reaching retirement, I went to see my IFA to say, look, and I'm AFPC qualified, IMC qualified. I've got, I could do his job. I can't do it now because it's been so long since I was qualified, but I've not got CPD, but I know enough. So I went to see him and said, well, yeah, all right. I need to start taking money out of the fund. It's going to be this amount a month. Are we happy? He said, oh God, that's way within the bounds of thought. You're not even, you're way below the maximum thresholds of anything we'd worry about. 2 weeks later, a 92-page report thuds onto my doormat that justifies the request I've made that he's had to go through for compliance purposes. Now, I defy the standard consumer to be able to get past page 3 without either falling asleep, be totally confused, or totally lost because of the terminology that's used. It is just shockingly bad. And then you get into some of the tables and graphs to prove that, we're running it at this rate or that rate, you're taking this at that. What? It's just absolute buffoonery to think any normal consumer, because I was watching recently some videos we did in Protection Viewpoint recently. We did 16, they're called, it's qualitative research, but they record answers to questions for us and we can watch them. Now, given that we say that the average consumer in the UK is a reading age of 11, you then get into listings people talk about. Some people have bought the product, some haven't. And you listen to the language they use and the emotion they have. They are not people like us. They are people who struggle to understand how money works. Never mind how a complex product like insurance works or how a mortgage works. These people need their handholding in simple language, not the terminology we use and the acronyms we use. It's just crazy, absolutely crazy.
Yeah. No, completely understand. And that modern technology, the TikTok, the bite-sized learning has to be the future. And
it is the future.
Those advisors out there who are embracing that are
as long as I don't have to sing on it, it's fine.
Well, we're singing and dancing as part of the podcast, but we'd have to
dance. I'll dance. I'll dance
on as well. So, Robert, I just thought we could actually talk for hours, because we've touched on so many different topics, but this is a bite-sized version, and I think we'll come back and talk to you more next year when you've retired, because I know you're not completely leaving the industry, because I know you've got that passion. But I want to know, what is your main aim and aspiration when you retire? Is it inside the industry or something outside?
I'm currently a non-exec director at the Darlington Building Society, and I'll carry on doing that. And I hope that maybe one other firm might offer me a role working with them, whatever that is. We'll wait and see. And I'm in some discussions with a particular firm about doing all of their conferences next year, which is really interesting. So I won't leave the industry entirely, and I wouldn't want to, because I think, you're right. I have a passion and a care about what matters in this industry that I think I can still hopefully add some value around the debate, if nothing else, even if it's just my ability to come in, drop a few hand grenades and walk away as they explode. But the thing I probably want to do is, in a couple of years, I'll be 70. And so in the world of athletics, every 5 years, if you're in vet athletics, you have a better chance of achieving something significant, because the age band's going 5-year cycles. So when I'm 70, I would like to be in the position where I could try and run the 100 meters in less than 13 seconds. So I've no idea what speed I could do it. At the moment, I don't really care. It's just some way to give me a purpose to get up in the morning, go and train, drink less, eat less, and probably sleep a little bit more.
That's fantastic. 13 seconds. That's great. That'd be
That's
amazing.
very
If
quick.
the time actually won't matter at the end of the day. It's the fact that I will, for 2 years, try to get somewhere close to it and of that purpose in life.
Yeah, start with
although
15. 13 just been so quick.
As one of my friends said, I do not want to be anywhere near you in the last 3 months of that if you're not getting close to it.
Yeah, the
Rob,
frustration.
I wanted to ask you one final question, if I may, because I think it's appropriate, because in the nicest possible way, you are known as being quite controversial and quite sort of upfront with your views. So I wanted to ask you one final question, if I may. There's been a big controversy in the news recently with the outgoing president of the United States and the power bestowed on him to pardon people, which I think is incredible. But he's done what he's done. Not from a criminal perspective, obviously, but if you had one power or one thing that you could change about this industry with the outgoing CEO of Amy, what would it be and why? What would you change?
Oh, that's a horrible question. Where would you start with that? I mean, that is really quite a difficult one.
Would it be regulation? Would it be consumer education? When I say, what would make the biggest?
I think you've just probably picked on it. I mean, I was asked a similar question on a different topic yesterday. I said the one thing I've learned too late in my working career is that if you actually pick the right people in a job, don't micromanage them and leave them to get space to get on with it, but actually trust the fact you've made the right choice and allow them to grow to prove you've picked the right person. Don't actually keep trying to find a way to evidence you've made the wrong decision, because that's not a great place to be. The one that I think you're right is, if I could make financial education compulsory in schools for every age of, let's say 12 through 13, where there was a series of modules they compulsorily had to go through, so that they came out understanding fundamentals like how bank accounts, credit cards, savings accounts, mortgages work, how the tax system works, so that when they turn up at work, they don't get a surprise, but what's this NI and tax thing? And all the stuff that links to that about the importance of compound interest. If people don't understand compounding, they are in a real trouble when they come to the world of life, of understanding the impact of that on them potentially. It's those stupid, simple things, in my view, that a brain like mine grasps like that, but many people need to be held by the hand to actually. And if we did that, and we did that compulsorily, guess what? They'd go home and educate their parents, and we get 2 generations for the price of one.
Yeah.
And then I think we'd have a much better society who understands and can add value to themselves, which protects everybody in the longer term. The economic spin out of that would be huge.
Perfect.
That gets my vote.
I think, we're all there. Super. Well, Robert, it's been really interesting to have a chat with you. Far too
Fantastic.
short. I do think we will have you back again in the future if you wouldn't mind coming on.
Pleasure.
Super. Thanks for your time, Robert.
Yeah, thanks, Trevor.